In this segment, we're going to take a close look at the causes and consequences of the great stock market crash of 1929. The United States had emerged from World War I as a global power, not just militarily, but also economically. The stock market boomed, and optimism of the 1920s was generated with investments made with borrowed money. When those businesses failed and stocks lost their value, prices fell, production slowed, banks collapsed, and unemployment became widespread. As we analyze the specific causes of the stock market crash, we note that during the 1920s, businesses were booming, but investments were being made with borrowed money. And so we had what we consider over speculation. That is to say, people were gambling with money that they were borrowing. There was an excessive expansion of credit, both individually by individuals who were borrowing money, but also by banks and by businesses. As businesses failed, bankruptcies occurred. And when bankruptcies occurred, that is to say businesses went out of business, employees lost their jobs, which led to even harsher economic situations. Bank deposits that had been invested in the market were now gone. And as banks lost their money, they were forced to close when the stock market collapsed. The big crash came in October of 1929, and America was never going to be the same again. This is the moment, this is the spark that most historians look to as marking the beginning of the Great Depression. Though the economy was slowing ahead of time before this, we could sort of see it coming. This was the harsh reality and marking the beginning of the Great Depression. The consequences? Well, as clients panicked and attempted to withdraw their money from the banks, there was unfortunately no money to give them. When banks had to close up because they didn't have any money to give to these clients who were trying to withdraw their money, the banks closed, along with all of the investments, the deposits made by everybody else. Another panic was going across the stock market. People panicked and tried to sell their stock to get whatever value they could. With the laws of supply and demand, the supply of stocks went way up. The demand was way down. Stock value plummeted, which further compounded the problem. There were no new investments in the banks, as people had lost their money and they grew to not trust the banks. Banks did not see new investments, and therefore, without the money to loan out and then recollect, banks also were going out of business. Banks collapsed, fortunes were lost. The stock market collapse will provide that spark, the kick to send the nation into the Great Depression.